I'm here today with Wes Crill from Dimensional Fund Advisors. And Wes, there's been a lot of talk recently, I guess it's always around, of this value versus growth argument. It's not much of an argument, is it?
Well, in our minds, the intuition behind value investing is about as basic as it gets when it comes to finance. It's the idea that if you pay a low price relative to a stream of future cash flows, that represents a higher expected return. And that's an evergreen piece of logic, by the way. It doesn't change in terms of that attitude through time. We believe low prices associated with higher expected returns at all times and then across all segments of the market. But we do know that, like most premiums that are presented to you by markets, there is uncertainty around it. There's volatility in stock returns, and that flows through to there being long stretches for the value premium in particular, but any premium, even including the equity premium, generally speaking, where we can see long periods where this premium is not delivered. It just so happens that we were coming out of a relatively long stretch where value stocks were underperforming growth stocks. So that's something that we spend a lot of time trying to educate, trying to set expectations around by looking at the historical data. I think one episode that was interesting was looking at the first half of this year, where you had 2 quarters where value was underperforming growth, and the cumulative underperformance of value versus growth was 20 percentage points, a little bit over 20 percentage points. And so that got me wondering, how often does this happen in the historical data? There's actually been 9 such previous episodes in U.S. markets where value underperformed growth by at least 20% over 2 quarters. The nice thing is what happens coming out of those 2 quarters. So if we look over the subsequent 1-year period, on average, value outperformed growth by almost 29%. So it just kind of goes back to this notion of, we believe in the premium every day. We believe it can show up in bunches, and the best way to capture that is to have a consistent focus on it and try and ride out those periods where value delivers disappointing results.
Yeah, what was also interesting about this latest quarter, which, depending on when our viewers are watching this, it's relative to almost any time frame. It can switch on a dime. In this quarter, the latest quarter we looked at, it was going from 2 consecutive really negative quarters for value versus growth. They both performed along the same lines, but growth beat value by a lot. But then it just turned on a dime the next quarter, and seemingly out of nowhere. So, I mean, the value versus growth premium is unpredictable, and it's also can change very rapidly, correct?
It can. If you're looking at short-term periods, whether that's quarter to quarter, year to year, I mean, even over on an annual basis, value is beating growth about 2/3 of the time. And then you look over 10-year periods, and that frequency increases as you get to longer and longer time horizons. But even over rolling 10-year periods, value has outperformed growth about 80% of the time. So it's something for investors to keep in mind when you're thinking about going through these stretches. And the natural reaction is always going to be, did something change? Did value underperform growth over the past, say, year because something has fundamentally changed about markets? And we would argue that many things change in the course of financial markets, but none that would underpin that logic of a low price being associated with higher expected returns. And because we know that there's uncertainty around this premium in the historical data, I think it's important to see that to be more comfortable with the uncertainty when it greets you in the future.
Yeah, and again, Dimensional offers ETFs and mutual funds that are multi-factor, correct?
We do. And in fact, that's an excellent way to potentially complement the behavior of the value premium, is to have a multi-factor type of approach, in particular the profitability premium. So the return difference between high profitability stocks and low profitability stocks has tended to be up when the value premium was down. And over the last 10 years, the balance, if an investor had a balance between those 2 premiums, whether that's done in a combination of different portfolios or just overall in one strategy, has helped mitigate the underperformance that would have been the result of the value premium. So they're a good complement. It also tends to be the case that high profitability stocks are different groups of stocks than value stocks. So there's a diversification benefit from having those in a portfolio.
Okay, so they kind of work together in a complementary fashion.
Yeah, exactly. I sometimes describe the difference in the composition of the stocks as like if I make two lists of foods, one of them is the kind of foods I like to eat, and the other list is foods that are actually good for me and healthy foods. There's not a whole lot of overlap there, but by managing my exposure between those two and finding a balance, I can land on a diet that's more sustainable and will lead to better long-term results.
Well, thank you very much for your time again, Wes.
Yeah, thanks for having me.